All right, so continuing from where, we left off, you can see the negative supply shocks. So a reduction in supply leading to higher inflation. Permanent supply shocks. So what I've gone through with, I went through in the previous session was looking at this temporal supply shock. So the short-run supply curves, aggregate supply curves were shifting either to the left or to the right. Here we look at the permanent supply shocks. And here we are seeing the permanent supply shocks are the changes in the long-run aggregate supply shocks. The long-run aggregate supply shocks will trigger permanent supply shocks. Okay. Remember the short run, in the end, you still return to your long run, right? You still move back to your long run potential. So a permanent negative supply shock, such as an increase in ill-advised regulation, the regulations that cause the economy to be less efficient, or reduction in supply, okay, thereby reducing supply, could decrease potential output. So anything that affects the long-run aggregate supply curve can lead to permanent supply shocks. Supply shock, negative or positive. Okay. So decrease potential output, as I said, the long run is the potential output, and shift the long run aggregate supply curve to the left. Anything that negatively affects the long run, your output, your potential output will shift to create a new potential. Okay, a reduction in your new potential, so to shift the long run aggregate supply curve to the left. Because the permanent supply shocks result in higher prices, there will be an immediate rise in inflation, and so the short-run aggregate supply curve will shift upward to the left also. So you can think of this, the short-run shocks from short run that takes you into your long run. However, so short-run supply curves, there's a shift to the left, which increases inflation to 3.5, then another shift to the left, that further increases inflation to 5%. When you have a permanent supply shock, it takes you straight to higher inflation. Okay, straight to higher inflation. It might go through some short runs, but it's very rapid. It's like your economy have just contracted, right? It's become much smaller, and so it leads to the effects are very instantaneous, or can be instantaneous. So because the permanent supply shocks result in higher prices, there will be an immediate rise in inflation. Okay, so the short-run aggregate supply curve will shift also to the left. Okay. All right. One group of economists led by Edward Prescott believes that the business cycles, what we started off with, the up and downward movement of the economy, or aggregate output, result from permanent supply shocks alone. So his argument is that the increase in output and reduction in output and all this up and down movement is driven mainly by permanent supply shocks, okay? And their theory of aggregate economic fluctuations is called a real business cycle. So this real up and down movement is just driven by the permanent supply shocks. All right, so this is the case of the permanent negative supply shock. This is the long run aggregate supply curve, 1. And then if you have a permanent negative supply shock, that will shift it to the left, okay, straight to the left. So you are moving from point 1 to point 3 rapidly, okay. So a permanent negative supply shock shifts long run to the left, and AS will also rise. The economy returns to the long run equilibrium with output permanently lower and inflation permanently higher. So you are returning to your new normal. Okay, your new normal is a new potential. First, you're producing at 10. Because your long run have been affected, you have a reduction to 8. Okay, and that leads to a higher inflation. Okay. Remember when we went through the long run, the shift factors for the long run, you should be able to go through population, all this capital stuff. Okay, should be able technology and all that. So if you have a bad technology that will shrink your long run, or lower capital investment, all these things will reduce your potential of the potential of the economy. Okay. So you are moving from 2% rapidly to 5%. But we are saying there may be some short runs in the middle. Supply will begin to shift, but then we are saying this movement to 0.3 is very rapid. Okay. And this is a positive supply shock. And that positive supply shock means the economy's potential to produce goods and services, the long run potential just increased. Okay. And that will trigger a reduction in inflation. Okay, you can see that. So in conclusion, aggregate demand and supply analysis yields the following conclusions. A shift in the aggregate demand curve affects output only in the short run and has no effect in the long run. Okay, so it has no effect in the long run if you have a shift in the aggregate demand curve. The aggregate demand curve shifts do not have any long run effect. A temporary supply shock affect output and inflation also only in the short run and has no effect in the long run. Okay. However, a permanent supply shock, which is a long run supply shock a shift in the long run supply curve, will affect output and inflation both in the short run and also in the long run. So if you have a long run permanent supply shock, that will affect inflation in the long run definitely, but also in the short run, so into the long run. Okay, so just to recap, a shift in the aggregate demand curve affects output only in the short run and has no effect in the long run. And a temporary supply shock affects output and inflation also only in the short run. However, a permanent supply shock, which is the long run supply curve shifting either to the left or right, will affect output and inflation, both in the short run and also in the long run. Okay. And we are saying that the economy has a self-correcting mechanism that returns it to its potential output at the natural rate of unemployment over time. So you always return to your potential output. Okay. Even a permanent supply shock, you return to your potential output, but to be a new potential output. All right, so that summarizes the analysis that summarizes the shift factors coming from aggregate demand and also aggregate supply. The next thing that we have to look at is also going through something we call the Phillips curve and how that also relates to the aggregate supply curve. Because ultimately we are interested in how the aggregate supply curve will shift will have the impact it will have on inflation and output. But there are some relationships that we need to understand very carefully. Okay. The first relationship is the relationship between unemployment and inflation. So we've been talking about aggregate supply increasing or decreasing and having effect on inflation. But a very important variable factor in the economy is employment rates and unemployment rates. And what is the relationship between the unemployment levels in the country and the inflation rate? Okay. And we are saying that there is a negative relationship between unemployment and inflation. And this is referred to as the Phillips curve. Okay. The relationship between unemployment and inflation. What happens to when unemployment increases? What happens to inflation? Okay. So an increase in unemployment or a decrease in unemployment, what is the effect of that on inflation? The idea behind the Phillips curve is very intuitive, saying that there's a negative relationship. So an increase in unemployment means there's a reduction in inflation. Okay, so inverse relationship. Or a reduction in unemployment means it's a higher inflation, an increase in inflation rate. Okay, so if the unemployment rate is coming down, say we have 5% or 10% unemployment and it's coming down to 5%, we are saying that you might see inflation also increasing. Okay. So the idea behind the Phillips curve is very intuitive in the sense that when labor markets are tight, when we say labor markets are tight, that is the unemployment rate is low. Okay. So a lot of people who want jobs, most people who want jobs have jobs. Unemployment rate is very low. It means that firms may have difficulty hiring qualified workers because those who want jobs, they all have jobs. So if you want to hire a worker, you have to pay the person a higher salary, right? and that may lead to higher inflation because they are paying so much money and they are consuming, so price levels begin to increase in the economy. So we are saying that when the labor market is very tight, that is the unemployment rate is very low, firms may have difficulty hiring qualified workers and may even have a hard time keeping their own workers. So some of their own workers, they may have to promise them a higher deal or higher salary to keep them. Okay. Because of the shortage of workers in the labor market, firms all right. So because you are giving them a higher, one, you are paying higher wages for your firm, and means that the cost of doing business have increased, therefore you have to charge a higher price for your good. Okay. Also, you are paying them a higher wage, and for that reason, they are going to the economy to consume and price levels will rise. So there is this relationship between the unemployment and inflation. When we have a very small unemployment rate, we are saying that it may be difficult to hire new workers and also keep existing workers. And to keep them, you have to pay them a higher salary. And if you're paying them a higher salary, you have to charge a higher price for your good. And they also have to buy goods at a higher price because more people have higher incomes. Okay. So there's this relationship between, and that is what we refer to as the Phillips curve. There is data that shows this relationship between inflation So between inflation and the unemployment rate for different countries. So a reduction in inflation, an increase in inflation will mean a reduction in unemployment. Okay. So the short run and the long run Phillips curve. So this relationship that we are talking about, you can also look at it from the short run. What happens in the short run when unemployment is reducing? What happens in the long run? What happens when unemployment is reducing? Okay, we are saying that in the long run, it may not have effect on inflation. Okay, in the short run, this negative relationship may hold, but in the long run, we are saying it will not have a strong effect. What do we mean? How do we demonstrate that? Here you have the long run Phillips curve. So this is the long run Phillips curve. And the long run Phillips curve is giving you an unemployment rate of around 5%. Okay. And then you have the short run Phillips curve, PC at 1. So you are 0.1. And you're saying a decrease in the unemployment rate. If you have a decrease in the unemployment rate from 5% to say 4%, okay, to 4%, that will increase inflation. Okay. From the example that we just mentioned, inflation will increase. So an increase in unemployment rate leads to a movement along PC1, which is this PC1, resulting in higher inflation. So there's higher inflation, which is 3.5%. Okay. When you have higher inflation, you know expected inflation will kick in. So expected inflation rises, shifting the PC upward to 0.3. Much higher inflation, 5%. And this is exactly what we explained about the negative relationship between the unemployment and inflation. Because unemployment there's a decline in unemployment to 4%, but that is leading to higher inflation levels. Okay. We are saying in the long run, you always move back to your potential. So until PC curve, which is PC, where unemployment is at the natural rate, you still return to this natural rate of unemployment, okay, which is 5% unemployment. It's just that has led to this higher inflation levels that we have. So 10% inflation. Okay. So if you have this short-term case, you have a case where there's a short-term reduction in unemployment, it will lead to slightly higher inflation, and then the short term will take you into the long run where you are back to your long run potential. Okay. Just like we did for the aggregate supply and demand shocks. Okay. So 3 important conclusions when it comes to the trade-off between the the inflation and unemployment is that there is no long run trade-off. Okay, the long run, you cannot say that, okay, I'm an economy, I'm going to, if what I can do is that to have a reduction in unemployment, let me try to put a policy in place that will increase inflation. Okay, fine. If you put policy in place that will increase inflation, like giving a reduction in interest rate, blah, 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 which increases investment, but also triggers, increases investment, increases employment, but also triggers higher inflation. In the long run, we are saying it that this policy will still return to your long run unemployment rates, okay, which is 5%, and at a higher inflation. So there is no trade-off to say that let me increase inflation rates so that I can get higher unemployment rates. Okay, so and then that will not happen. You will always return to your full potential. Okay? It's a very good thing to understand this. You say that firms like higher prices. So let me give firms higher prices and they'll produce more and then they will employ more. But we are saying that this effect is just for short run. Okay? In the long run, the higher prices will not lead to higher employment rate because the economy will return to 8 potential unemployment level. It means that to solve the unemployment situation, the long run potential of the economy itself has to increase. Okay, you cannot deal with short run firms taking advantage of short run profitability to reduce unemployment. It has to be structural. It has to be within the economy. The capital stock, the technology, and other things have to increase employment. But short-term potentials like the trade-off between inflation and unemployment, or let me increase inflation, or let's put in policy to drive prices, and firms will supply more, employ more. This will only have effect in the short run. It will not change the structure of the economy. Okay. So it's important. There is no long-run trade-off between unemployment and inflation. Okay. There is a short-run trade-off between unemployment and inflation, and there are 2 types of Phillips curve, also the long run and the short run. So these are very important conclusions you should have when it comes to the Phillips curve, which is the relationship between unemployment here and inflation. Okay. So one important thing linking the Phillips curve to, we have linked the relationship between the inflation and unemployment. You can also think of relationships between the unemployment in the economy and other variable factors in the economy. Okay, so to complete our aggregate demand and supply model, we need to use our analysis of the Phillips curve to derive a short-run aggregate supply curve. What is the relationship between the unemployment in the economy and the aggregate supply, the output in the economy? And this represents the relationship between total output that the firms are willing to produce and also the inflation rates that exist in the economy. All right, so to complete this analysis, what we would do is we can translate the modern Phillips curve, the Phillips curve that we just seen, into a short-run aggregate supply curve by replacing the unemployment gap, which is your unemployment levels and the natural rate of unemployment, with the output gap, okay, which is the difference between your output and your potential output. Okay, you can easily go back. You see how. So this is our N, our unemployment U, and this is our natural level of unemployment, which is UN. Okay, so this is the unemployment gap that we have here. Okay, and we say that we can look at the relationship between the unemployment gap and also that of the output gap. Okay, so replacing the unemployment gap with the output gap, the difference between output and that of the potential output of the economy. All right, the Okun's law describes the relationship between the unemployment gap and the output gap. What is the relationship between the unemployment gap and the output? If I bridge the output gap, what happens to the unemployment gap? Okay, so it's very important relationship as well. the Okun's law states that for each percentage point that output is above potential. Okay, think of it. Your output is above potential. You're producing beyond potential. That's what it means. The output is above potential. Okay. If your output is above potential, if you think about unemployment, that means that the unemployment rate will be below its natural rate. Because it means that if your output is above potential, it means that the economy is producing beyond its potential, meaning a lot of people have been employed, okay, which will translate to the fact that the unemployment rate that will be there will be below its natural rate. If the natural rate of unemployment is 5%, because the economy is producing beyond the potential, the unemployment rate will be like about 4%, okay, or less than 5% in general. Because the economy is producing below the potential. So it's the relationship between the output gap and the unemployment gap. So for each percentage point that output is above potential, the unemployment rate is also half of a percentage point below the natural rate of unemployment. Okay. So if you are above potential in terms of output, the unemployment rate will really fall below its natural rate. If you restate it the opposite way, then alternatively, for every percentage point that unemployment rate is above natural rate, if your unemployment rate is also above its natural rate, if the natural rate is 5%, but your unemployment rate is 10%, it means it's above its natural rate. There's way too many unemployed people beyond potential. Then it means that your output is below potential. If you are inefficient and your output is below potential, then the unemployment rate will be beyond its natural rate. Okay, so that is the relationship here. Alternatively, for every percentage point that unemployment is above its natural rate, the more people unemployed, then output will be below its potential output. Okay. So it's simple. Just go into a country, if they are producing below potential, then the unemployment rate will be above its natural rate. Okay. If you go into a country and they are producing beyond their potential, then the unemployment rate will be below its natural rate. Okay. So that is the idea. You can think of it even for developing countries. Our unemployment rate, if you're inefficient, the unemployment output will be below its potential, meaning that we will be having an unemployment rate which is above our natural rate if we were very efficient. Okay. So that is the Okun's law. It describes the negative relationship between the unemployment gap and also the output gap that we have. Okay, so that is the graph that we have. Okay. If the unemployment rate here is below, if unemployment rate is below, if the unemployment rate is, if unemployment rate is below, which is minus, we have minus unemployment or negative. Unemployment is below potential, then you have output which is above potential. Okay. So say unemployment rate is 5% below its potential, then your output will be above potential. Okay. And here is the opposite. If your unemployment rate is above potential, say 4% above potential, that means that your output is a certain percentage point below potential. Okay. So your output is minus 2%, and if your unemployment rate is 3% above potential. If your unemployment rate is 3% above potential, it means that your unemployment is 3% above potential. It means output is negative, you're below potential. So, okay, so minus 2% below potential. All right. So that summarizes the aspect of aggregate supply and aggregate demand curve. Just take your time, go through the audios, and if there are any questions, I'll have the last session, try to have the last live session, and then if there are any questions, I can answer those questions. Okay. We have one more broad theme that we have to talk about briefly before the end of the semester, and that would be financial crisis. And in the last audio or live session that we had, there were a lot of questions regarding this financial crisis. So we touched a few things on that before the end of the sessions and before the exams starts. Okay. Have yourselves a nice day.